In the early 2000s, there was a hidden crisis brewing in the land of finance, the US housing market, which led to the great financial crisis. For those of you who are watching this video, you may remember it was a time of extravagance for most Americans. Everyone bought whatever they wanted on credit with nearly no documentation. But no one was saving. No one was taking caution. In 2004, the savings rate of the average American was 1.8%. 1.8%. This is the worst it had been since 1934 during World War II. Remarkable. But the market was booming, fueled by low interest rates and lax lending practices. Subprime mortgages, loans made to borrowers with poor credit, were being repackaged and sold as high-quality investments, spreading the risk far and wide. During this time, there was a man named John Paulson, a seasoned investor and founder of the hedge fund Paulson & Co. One day, while studying the market, Paulson noticed something wasn't adding up. He saw that the housing market was overvalued and built on shaky ground. With his team of analysts, they dug deeper and found the ticking time bomb: subprime mortgage-backed securities. The stage was set for one of the most daring bets in financial history. Paulson decided to go against the market consensus and bet on the collapse of the housing market. This all in the face of rising equity markets and unprecedented growth in average price of real estate. To do this, he used a financial instrument called a credit default swap, or CDS, which allowed him to bet against mortgage-backed securities. Paulson saw an opportunity to profit from the eventual collapse of the housing bubble by using credit default swaps. CDS are financial instruments that act as insurance against bond defaults. In this case, Paulson bought CDS on subprime MBS, effectively betting that the underlying mortgages would default and the value of the securities would plummet. Paulson went to several investment banks, including Goldman Sachs and Deutsche Bank, to help him structure and execute his trade. They agreed to create and sell his CDS on subprime MBS, enabling him to place his bet against the housing market. These banks gladly took the opposite side of his trade, high-fiving their way to guaranteed profits along the way. Thinking John was a wild gambler that was off his rocker, but Paulson held his ground. He believed that the housing bubble would eventually burst, and when it did, his fund would reap enormous profits. As the next year passed, the housing market continued to soar, and many investors laughed at Paulson's seemingly foolish bet. However, he remained steadfast in his conviction, even as the cost of maintaining his position grew. Then in 2007, we all know and remember well what happened. The housing market began to collapse. Subprime borrowers defaulted on their loans, sending shock waves through the financial system. Mortgage-backed securities, once thought to be safe investments, crumbled in value. Suddenly, John Paulson's bet against the housing market didn't seem so foolish. As the market spiraled downward, his fund's CDS positions skyrocketed in value. Wondering what happened with Paulson's bet, in 2007 alone, Paulson & Co. reportedly made around $15 billion, with Paulson himself pocketing an estimated $4 billion. To top that, the following year, his fund made another $5 billion as the crisis deepened. Paulson's big short had paid off in a massive way, and he became a financial legend. The tale of John Paulson and his multi-billion-dollar bet serves as a reminder that in the world of finance, fortune favors the bold and the well-informed. As the story of John Paulson's historic trade spreads far and wide, the world will remember the man who saw the collapse coming and had the courage to bet against the tide. As Warren Buffett says, you can't tell who's swimming naked until the tide goes out. Paulson, he saw the same thing. Profits on the back end of this great unprecedented run-up in housing based on shaky grounds. And so, the legend of John Paulson's billion-dollar bet will live on, inspiring future generations of investors to challenge the status quo and seek opportunities where others see only risk.